My name is Katie Gibson. I'm an associate here at Maynard Cooper Gale in the Corporate and Tax Department. And today we're going to talk about choice of entity and upon formation of your entity, which business form you want to choose. So the main things we're going to talk about are what your entity choices are. There are a couple main ones we'll hit on. There are actually several different ones under state law that you can choose, including professional corporations, different types of partnerships, limited partnerships, general partnerships. So there's a broad array of choices. We'll hit the high level ones, the ones that are most popular, and then we'll talk about specifically the tax considerations that you should take into account when deciding what entity is right for you, and then the non-tax considerations. So the first step when you decide you want to start a business is decide, well, what type of entity do you want to form? And often that's a choice you'll make with the individuals that you're forming the entity with in consultation with your accountant and also a lawyer who can walk you through what different options you have under the specific state. So the entities themselves are all creations of state law. So Alabama, for example, sets forth the different types of entities that you can choose to incorporate. For example, in Alabama, you can have an LLC, you can form a corporation, you can form a partnership, and then separately from that decision is the tax consequences or the tax elections you're going to make. And so, for example, you could form a corporation but choose to tax that corporation as an S corporation or as an LLC, as a partnership. And so all of that plays into this decision you're making when you form an entity. Other factors that influence the decision about what type of entity to create include the future goals that the owners have. So is this a short-term business for you that you're going to ultimately sell in the next couple of years? Do you have any idea if you're going to sell? Are you going to bring on additional investors, additional members, partners? All of that comes into play. And if you can decide on formation, what entity will suit you long-term, that's best. And as I discussed, you want to talk to your accountant and tax advisors and lawyers as well when making these decisions. One other thing that you want to think about when forming your entity, and that's outside the scope of this presentation, is what law do you want to govern your entity? Say, for example, if you were creating a business here in Alabama, one of the things we would talk to you about is whether it makes more sense to form it as a Delaware entity. There's a lot of different reasons why Delaware is one of the most popular states to form an entity in. It has a robust amount of case law governing the various rights members and shareholders have with respect to entities. So oftentimes people will choose to form a Delaware entity even though their business is located in Alabama. So as I just talked about, there's sort of the state law entity, and then there's also the tax status attributable to that entity. And those two things can vary, right? So you might form a limited liability company, and then you have to decide, well, what tax rules are going to govern that LLC? And as we'll talk about shortly, there's sort of these default rules that the IRS has created. For example, when you form a C corporation under state law, by default, unless you do something else and make another tax election, you will be taxed as a C corporation with the IRS. But you can always form a C corporation and then make an election to be taxed as an S corporation, for example. So under state law, you're a C corporation, but in the views of the IRS, you're an S corporation, and the S corporation tax laws would apply to you. And so when you're thinking about forming an entity, your first choice is, well, what entity do you actually want to form? And sort of second, but really close to that is, well, once I form this entity, how do I want this entity to be treated by the IRS? And so just looking at the slides here, the common state law entities, though certainly not all of them, this is not an exhaustive list, is C corporations, partnerships, and limited liability companies. And when you're thinking about partnerships, think about, there's limited partnerships, there's limited liability, limited partnerships, there's a broad array of types of partnerships that we're not going to cover in detail. Similarly with LLCs, you can have a single member LLC or a multi-member LLC. And then when we're looking at the tax status, so you can be taxed as a C corporation, you can be taxed as an S corporation, and notice that S corporation is really just a tax identification. It's just a tax election. There's nothing under state law where you would create an S corporation under state law. What you would do is you'd create a C corporation and make an election with the IRS to be taxed as an S corporation. Partnership and disregarded entity. Now, if you'll notice over on the tax status side, there's nothing for LLCs over there. That's because in the views of the IRS, there's no set of tax rules that apply solely to limited liability companies. So the default rules that apply to an LLC depends on how many members are in that LLC. If you have a single member LLC, then it's going to be treated as a disregarded entity by the IRS. And what that means is the individual owner of that single member LLC is going to be treated as directly owning the assets and liabilities of the assets that are owned by the LLC and the liabilities that run through the LLC. Whereas if it's a multi-member LLC, it's actually by default going to be taxed as a partnership. So you can sort of see the interplay between the state law entities and the tax status that's applicable to those state law entities. And so we're going to kind of dive into the various tax considerations. A lot of commentators will say, you know, the tax considerations should really be secondary to the non-tax considerations when you're deciding on what to form. And in my experience, most clients are primarily concerned with the tax considerations though. And that's what they want to talk about in detail when deciding what entity to form. So we're going to cover tax considerations in a pretty good amount of detail here, and sort of just brush over the non-tax considerations, just because, like I said, most clients really want to focus on the economics of the transaction, right? The economics of the deal. What are they getting into? And so, as I mentioned, the IRS has these default rules that apply to the entities. It used to be, before I think it was 1995, it used to be that in order to determine how an entity was taxed, the IRS had a set of 6 factors that they would look at, right? So it was a 6-factor test, and it was kind of a subjective test. And it was, you know, if the entity meets these requirements, it's going to be taxed as a corporation. If it meets these requirements, it'll be taxed as a partnership. If it meets these requirements, it'll be taxed as a disregarded entity. The problem with that came from interpreting those 6 factors, right? So different people would look at those same factors and that same entity and come to different conclusions. So in order to streamline this whole process, the IRS came up with what are now commonly called the check the box rules. And what that means is there are a set of default rules. So if you form a C corporation, you are automatically going to be taxed as a C corporation unless you affirmatively do something different. And those are what we call the default rules, encompassed in the check the box regulations. So the check the box regulations say, you know, you will be taxed as a C corporation unless you check the box on a specific form to be taxed as an S corporation. And so those have been very helpful in that it makes it a streamlined, easy process to determine, well, what am I taxed at now? And how do I get to an S corporation if that's how I want to be taxed? So like I said, a corporation is automatically taxed as a C corporation. An entity with a single owner, as we discussed, is automatically going to be classified as a disregarded entity unless it elects to be taxed as a C corporation, which would be highly unusual, but it has that ability to do that. Similarly, an entity with multiple members, so a multi-member LLC, is going to automatically be classified as a partnership unless it elects to be taxed as a C corporation. So you can kind of see when you're talking about an entity, you know, if say one of your friends has formed a multi-member LLC, you know, by default, you would assume that that will be taxed as a partnership, but you need to sort of dig in a little deeper and clarify, because they could have filed an election with the IRS to be taxed as a C corporation. And although unusual, it is done on various occasions for very specific reasons. You can't just automatically assume that because it's a multi-member LLC, it is certainly taxed as a partnership, although the default rules would categorize it as such. You know, it's important to decide on the front end how you want to be taxed. So not just the state law entity that you're creating, but also how you want to be taxed. Because while possible to convert at a later date, it can be difficult to do so. Say, for example, if you formed as a C corporation and a couple years later decided you wanted to be an S corporation for tax purposes, you certainly can convert to an S corporation, but there might be some built-in gain tax that you have to pay upon conversion, so it can be sort of costly to convert. And so ideally, you would make the decision on formation that's going to suit your goals long-term. So we're going to go through just a high-level overview of a couple of these entities and then dive into them in a little more detail. So a disregarded entity, that's a single owner entity that is completely ignored for tax purposes, even though under state law, it's a separate entity for legal purposes, right? So this would be your single member LLC. So if I went out and decided to form a business today, that was not a sole proprietorship. So a sole proprietorship would be something that is not incorporated, right? It's not an entity under state law, really. If I went and formed a single member LLC with just myself as the member, I would be treated as directly owning the assets and being responsible for the liabilities of that single member LLC for tax purposes because it's a disregarded entity. And so everything is going to flow through to my own personal tax return. Now, if I were to then go in and add a member to my single member LLC, I would automatically have converted it to a partnership. And so you just need to keep that in mind when you add another member to a single member LLC, you change your tax classification by default. Similarly, if myself and one of my friends started an LLC and it's a multi-member LLC and then they exited the business for whatever reason, it would automatically convert to a disregarded entity upon them exiting that business, since there's just one member of that single member LLC. So a C corporation, most people are familiar with, right? These are a lot of the big corporations are C corporations, subject to 2 levels of tax. So an entity level when earned, and when the distributions are made to the stockholders or the dividends are made to the stockholders, it's taxed at their level as well. So double layer. The sting that's associated with the C corporations have been reduced significantly since the Tax Reform Act occurred in 2019, because there's a flat 21% corporate tax rate, which is very helpful. So we're seeing a lot more entities become C corporations or form as C corporations or be willing to. Since that tax reform took place. You know, and as we discussed, so there's C corporation, there's an S corporation. We'll talk about the S corporation now. So an S corporation is not its own legal entity. It's typically a C corporation that has elected to be taxed as an S corporation, although other entities can elect to be taxed as S corporations as well. But I would say most common is a C corporation that was formed as a C corporation at the state level that filed a specific tax election with the IRS to be taxed as an S corporation. So what is an S corporation? It's a pass-through entity, and what that means is you don't have that entity level taxation that you have with the C corporation. It's similar to a partnership, right? In that the S corporation's profits and losses are passed through the entity to the individual stockholders, and those stockholders include their respective shares of the profits and losses on their individual tax returns. This is favored by a lot of our clients for efficiency purposes, to avoid the double taxation. You know, one of the things to be mindful of, though, is that since these profits and losses aren't stuck in the C corporation until distributed, they're passed through to the individual stockholders. What that means is if the profits and losses aren't actually distributed, if they're allocated but not distributed, you can get what's called phantom income. So in an S corporation, right, they have all these profits that they've made, but they are retained in the S corporation for business purposes. The shareholders decide we don't want to distribute out all of the profits right now. We want to hold on to it in the entity. You still have to report those profits as a shareholder on your individual tax returns. So that can create what's called phantom income, which can create a real tax burden for the individual stockholders or shareholders. What happens is your allocated profits, you didn't actually receive those profits, you know, there were no distributions of actual money to you, even though you were allocated those profits, and now you owe taxes on those profits you didn't actually receive. You just basically constructively received them, right? They were allocated to you. But yet you owe taxes on them. So oftentimes what we'll see in, you know, the agreements amongst the shareholders is a requirement that they distribute out funds for tax purposes. So mandatory tax distributions to help ease this financial and tax burden on the individual stockholder shareholders. Now, one of the problems with an S corporation is there are significant limits on who can be the members of the S corporation, or the shareholders, excuse me, of the S corporation. So with limited exceptions, only U.S. individuals can be the stockholders. So corporations or other entities cannot typically be the stockholders. You can see that that creates a problem, right? If you're looking to bring on private equity investors in the future, or looking to sell in the future. Additionally, you know, no more than only one class of stock. So that's problematic if you wanted different stockholders to have different rights, financial rights or voting rights with respect to their interest in the S corporation, right? So only one class of stock and only no more than 100 stockholders. That's less problematic for a lot of our clients, but the only one class of stock and only U.S. individuals as stockholders, those two limitations can turn out to be fairly problematic. And one thing to keep in mind is if you do have an S corporation and you issue what the IRS views as a second class of stock, you are automatically no longer an S corporation. And that can have some real tax burdens to the shareholders, the stockholders. And the problem there is even if you don't officially classify it as a second class of stock, if you were to issue additional stock in the future with less financial rights or more restrictive rights than the other classes of stock, then that's automatically going to be treated as a second class of stock, thus violating your S election status. So the next thing we're going to talk on is the partnership, right? So if you have a multi-member LLC, it's going to be taxed as a partnership. We don't form too many true partnerships these days, at least in my practice. Most clients are interested in the multi-member LLCs that are then taxed as a partnership for various reasons. A lot has to do with liability. So the partnership is a pass-through entity for tax purposes, meaning again, like the S corporation, right? There's no entity level tax, and you should be keeping in mind this will similarly have that phantom income problem, right? So the profits and losses are allocated amongst the partners and passed through to the partners who include their respective share of those items on their own income tax returns, whether or not distributed. So again, in the partnership agreement or with respect to an LLC in the operating agreement, which is the agreement that's between the two members or three members, however members there are, that govern their respective rights and obligations, we typically would include mandatory tax distributions in there, so as not to burden the individual members with this phantom income or having to pay tax on profits not actually received. So unlike an S corporation, a partnership doesn't have these restrictions on the number of shareholders or the types of shareholders or the residency of the owners, right? So you can have foreign owners in a partnership, you can have 150 owners in a partnership, you can have different classes of stock or really partnership units. And so it provides a little more flexibility. The other thing that's really helpful about a partnership, or really what I'm referring to as a multi-member LLC, because that's how it's most often used, is you can have different economic rights amongst the partners. So you have broad discretion in an LLC or a partnership to have what we call waterfall distributions, which are basically just different economic rights amongst the partners. So you might have two partners come in at the same time, 50-50. But for whatever reason, the value that you attribute to one of the partners is a little more, right? So you want them to be 50-50, but you want this guy to get a little bit more of the profits until a certain amount of profits are reached for him, right? Till he gets, say, $100,000. And then you want it to go back to 50-50. So in a partnership, you would be permitted to do that. You can sort of structure the economic rights of the members as you see fit, subject to some limitations by the IRS. There are some tests that they have to meet, but generally it's pretty flexible. Whereas an S corporation, right, that would not be permitted, because if you were to do that, that other individual would be treated as having another class of stock, which would violate the S corporation election rules, and you would no longer be an S corporation. And so that can be very helpful, having that flexibility in the partnership. You know, additionally, all trade or business income of a partnership is generally considered self-employment income to the partners and subject to self-employment tax. So that's the downside of the partnership. Whereas if you compare that to an S corporation, right, S corporations, generally only the compensation income actually paid to the stockholder employee is subject to employment tax. Any other income is not subject to employment tax, and that can amount to a significant savings with respect to employment taxes with respect to the S corp. So as you can see, we talk about the benefits and burdens of a partnership LLC really versus an S corporation, which is really a C corporation, right, where we've made an S election with respect to that C corporation. There's no clear right entity. You have to evaluate what's important to the members, what the economic relationship is among the members, what the long-term plans are of the members, what the business itself is going to look like. And so there's really no clear cut, this is the type of entity everybody should use, this is the type of tax election everybody should use. It's really facts and circumstances based, which is why you're encouraged to, you know, coordinate coordinate with your various advisors in making that decision and make sure you're really thinking long-term, 5 years from now, where do we see this business? Will this entity and this tax election really fit our needs then or not? And so we're going to now sort of talk in more detail about some of the different types of entities we've discussed. So first, we're going to hit on the taxation of C corporations, right? So these are corporations, as we've talked about, formed under state law, where the default C corporation classification applies. They have not made an S election. And so what happens on formation of a C corporation? So one of the initial questions is, well, how are we going to capitalize your C corporation? So what are you going to use to put into the business? And there's sort of two buckets that the capitalization can take, the form of capitalization can take, right? Debt versus equity. So corporations can be capitalized with equity, meaning cash or property that's actually contributed to the corporation, or with a combination of debt and equity, right? And so corporations tend to really prefer debt. And as the shareholders of the corporation, you would prefer debt, maybe a combination of debt and equity, right? And the reason is because you get that deduction with the debt. Corporations can deduct interest payments on debt instruments, but corporations cannot deduct dividend payments to the stockholders. And so the classification as debt or equity has important tax consequences for the corporation and its stockholders. The general distinction between debt and equity for tax purposes is that a debt holder expects the payment of interest and the repayment of a specified sum at a fixed maturity date, regardless of how well the company is doing, right? And so anything that sort of meets that bucket is going to be classified as debt under the IRS. Equity, on the other hand, right, if you're issued equity, you expect to go with the ebbs and flows of the business. You will make money if the corporation makes money. You will participate in the downside when there's slower times in the corporation. But a lot of the holders would prefer to have equity over a debt instrument, right, because it allows you to participate in that upswing. So we have an example to show you the difference as to why corporations would prefer debt versus equity, right? So currently the corporate tax rate is a flat 21%. If a corporation wants to pay a $10 dividend to its stockholders, it has to have pre-tax earnings of $12.66. And why is that? It's because it has to pay tax. Remember, double taxation. So the corporation itself has to pay tax of $2.66 on the earnings before it can distribute out that dividend. However, if a corporation is financed with debt, so if there was some equity put in, but a good amount of debt put in, right? So they issued a note in exchange for that debt, the corporation would need to only have pre-tax earnings of $10 to pay the $10 in interest on that debt. And that's because the corporation can deduct the $10 interest payments from its $10 in earnings. But holders or individuals looking to invest in a company don't just want the interest payments, right? They're not looking to just loan money to the corporation and get some fixed sum of interest back. Usually people who are investing in a corporation want to really participate in the upside of it. They understand that there may be a downside, but they believe in the company and want to participate. And so the individuals will typically want equity in exchange for their contribution. So we talked about the stockholders typically prefer to have equity. And another reason why is because, note holders are taxed at ordinary income rates on the interest actually received, whereas they would receive a tax-free return of their basis in the event that they receive a dividend, and any additional dividends beyond their basis are just taxed as capital gain. So let's talk about the taxation of dividends. So individual stockholders are taxed on qualifying dividends at a preferential rate, which is a maximum rate of 20% for the higher income individuals. Plus there's this potential for a 3.8% tax on net investment income. But qualifying dividends is very broad, and it means dividends paid by U.S. corporations as long as you meet this holding period requirement, which is only 61 days. If it's not a qualifying dividend, it's taxed as ordinary income. But for the most part, you can expect that your dividend payments will be treated as qualifying dividends. Corporate stockholders, so they get a pretty good deal to where they get a dividend received deduction of 50% for non-related entities. So a corporate shareholder in another corporation, when that corporation pays a dividend to this corporate shareholder, they would get a 50% deduction on that dividend. it's 65% or 100% deduction for dividends received from related corporations. So that's pretty significant. So here's just a quick example covering that. If a U.S. corporation receives a $1,000 dividend from an unrelated U.S. corporation, so it qualifies as a qualifying dividend, it can deduct $500 of this dividend from income, including only $500 of that as income to that U.S. corporate shareholder. The tax on the dividend is taxed at that flat 21% rate, but you're only taxed on the $500 there. And so, another issue that comes up when you're forming an entity is, well, what if I want to put in a combination of cash and property, or just property? Say I have a building I want to contribute, or maybe one person has a building they want to contribute and the other person just has cash to contribute. So generally, you're not going to experience any adverse tax consequences on forming a corporation. Under Section 351 of the Internal Revenue Code, a contribution of cash or property to a corporation on formation is generally a tax-free transaction if certain requirements are met. So the first is that it has to be transferred or contributed solely in exchange for stock of that corporation. Second is a control requirement. So the contributing parties have to be in control of the corporation immediately after the contribution. And for this purpose, control is an 80% threshold. So you have to have 80% of the voting stock and 80% of the other stock in the corporation. This isn't individual though. This is collectively with those who are contributing to the corporation at the same time. So if there are 3 of us, we decide we want to form a corporation. I'm going to contribute property. The other 2 are going to contribute cash. We all contribute those in the cash and the property in exchange solely for the stock in that corporation that we're forming. Collectively, we more than meet that 80%, right? Because we're all 3 contributing at the same time. We're the only 3 shareholders. So we are in control of 100% of the voting stock of the corporation. So we clearly meet that 80% threshold. However, a contribution to a corporation may be taxable in very limited circumstances. In the event you receive what's called boot from the corporation in exchange for your contribution, then that boot will be taxed. So for example, if I were to contribute my property in exchange for other property from the corporation plus my stock, that other property would be taxable. It would be a taxable distribution to me. More than 20% of the stock in the corporation is issued to a stockholder solely for services. So services does not give you that qualifying, tax-free exchange. Or the contributing stockholder contributes property to the corporation and that property is subject to a liability, right? So if I'm contributing a building to the corporation, it's subject to a mortgage. That entity is going to take over that mortgage when I contribute it. So I'm saying I'm able to assign that mortgage over. Well, I'm also getting a relief of that liability when I contribute that property. And so that would be taxable to the extent that I was relieved of that liability. And so what happens with basis? And so the reason why basis is so important is basis is sort of your baseline interest in that property. And it's what indicates it's what sets the future taxation on any sales for you individually. And so basis is really important, and being able to track your basis in your stock and any property received is important. So when you contribute cash or property to a corporation, you'll take a carryover basis in the stock equal to the basis of the contributed property. So if I contribute a property that is, worth $400,000, but I only have a basis in that property of $200,000, so it's appreciated $200,000. When I contribute that property to the corporation and receive my stock back, I'm only going to get a basis of $200,000 in my stock. Whereas my friend over here, say she contributed $400,000 just in cash to the corporation in exchange for her stock, the basis she has in her stock is going to be $400,000. So you can see that I have $200,000 less in basis because my basis in the property I contributed was only $200,000. You don't look at the fair market value. The corporation is going to take a carryover basis in the contributed property equal to my basis in that property. So you can't sort of game the system by contributing property to an entity and having that entity take a step up in basis to fair market value. Rather, it's going to take a carryover basis. So let's think about that example, right? So in my example, I'm contributing a property that's worth $400,000. I have a $200,000 basis in that property. I'm going to contribute that property to the corporation. The corporation is going to take a carryover basis. So the corporation's basis is going to be $200,000. in that property that's now worth $400,000. If the corporation then goes and sells that property, right, for $500,000 in a couple of years, well, when looking to see what's taxable to the corporation, you're going to go, well, we have a $200,000 basis. We sold for $500,000, so $300,000 is the delta there. So that's what's going to be taxable to the corporation. So you don't get the benefit of the fair market value when you contribute it to the corporation. You can't game the system that way. So as a slide notes, the taxation on that property is deferred, not eliminated when you transfer the property or when you contribute the property to the corporation. And so, as we've discussed, the general tax scheme of corporations is the double layer of taxation, one at the entity level and one at the shareholder level. The corporations pay an entity level tax on their income at a single maximum rate of 21%. Interest income is taxed to the corporation as ordinary income, but that really doesn't matter, right? Because the corporate tax rate for ordinary income is, again, that flat 21%. But dividend income is subject to the dividend received deduction of 50%, or in some certain circumstances, 65% or 100%, which is very helpful for corporate shareholders. What happens when a corporation distributes some of its assets out to its shareholders, right? So the distribution of assets to stockholders is generally a taxable event, unless we're talking about a liquidating distribution. So in a non-liquidating distribution, meaning we are not completely forfeiting all 100% of the interest that shareholder has in the corporation. The corporation is going to recognize taxable income, and that's where the corporation's basis in those assets comes into play. And the stockholder is treated as receiving a distribution equal to the fair market value of the property distributed. To the extent that the corporation has current earnings, accumulated earnings and profits, the shareholder is going to be treated as having received a dividend, and then they'll take a cost basis in the property equal to its fair market value. So because you're being treated as receiving property equal to its fair market value for tax purposes, you also get that step up in basis of equal to fair market value of that property. Now, liquidating distributions of assets to stockholders. So a liquidating distribution is one where after the distribution, that shareholder will have, no more interests in the corporation is dissolving, it's liquidating, and so the assets of the corporation are being distributed out to all of the shareholders. Again, the corporation is going to recognize taxable income. In this case, the stockholder is treated as selling its shares to the corporation in exchange for the assets distributed, and that shareholder will recognize capital gain or loss. If the shares were held for more than 1 year, it's going to meet the holding requirements for long-term capital gains. And the long-term capital gains, again, is a preferential tax rate with a maximum of 20%, subject to, in some cases, the addition of that 3.8% net investment income tax. Corporate capital gains are not taxed at a preferential rate, but again, there's no difference, right? It's 21% flat tax rate. So the taxation of asset sales. So what happens when a corporation doesn't distribute out the assets to its shareholders, but rather engages in the sale of assets to a third party, right? So again, the sale of assets is going to be subject to this double layer of tax at the entity level. And then once those proceeds or profits are distributed out, the shareholders themselves are going to be taxed. By contrast, though, right, if we're talking about a stock sale, so if the shareholders were selling their individual, shares of stock, the entity is not really involved in that. And so the entity does not have any taxation with respect to that, just the shareholders. So the corporation will recognize taxable income or loss on the sale of the assets, but the amount and character is determined on an asset by asset basis. So you look at the asset itself and seeing if that asset would result in ordinary income or capital gains. It's a capital asset to the corporation, and then that's how those assets are taxed. But in most cases, again, a corporation is not concerned about the classification of the assets, whether it be, ordinary income or capital asset, like inventory is the typical ordinary income case, or like I said, the capital asset, because there's currently just no difference in the tax rates, right? It's 21% flat tax rate. The only exception to that is corporations can be affected by the classification of a loss, because a capital loss can only match up with a capital gain, right? So if you have a loss with respect to an ordinary asset like inventory, if you take a loss on the sale of inventory, you can't offset that against a capital gain. So on the asset sales, stockholders will recognize taxable income gain or loss on the distribution of any proceeds from the sale of those assets. And the tax treatment, again, depends on if the distributions are liquidating or non-liquidating distributions. For non-liquidating distributions, the stockholder is treated as receiving a dividend to the extent of the accumulated earnings and profits. And for for liquidating distributions, it's generally a capital gain or loss. And then the buyer will receive a cost basis in the acquired assets. Taxation of dividends. Dividends may be paid in cash or additional shares of stock. So sometimes when a corporation is going to make a dividend, the shareholders decide, well, we want to issue additional shares of stock in exchange, in lieu of cash distributions. So stockholders are taxed on the gross amount of any dividend paid out of the corporation's current and accumulated earnings and net profits. And any distributions in excess of that amount would be treated as a return of basis, which is tax-free. And then any amount above the basis, right, is considered capital gain. And again, the individual tax rate is a maximum tax rate right now for qualifying dividends of 20%, plus, again, that 3.8%. So what about in stock sales? So the difference between asset sales and stock sales comes up a lot when you're talking about selling the corporation in general. So sometimes you'll want to structure that sale as an asset sale. Sometimes you'll want to structure it as a stock sale. Oftentimes the buyers have a preference. So the sale of the stock results in one level of taxation, just at the selling stockholder level. It's generally not a taxable event for the corporation or the buyer. And the corporation's basis in its assets are generally unchanged after the stock sale. The buyer will receive a cost basis in the stock it purchases from the shareholders, so fair market value, right, what's actually paid. And the selling shareholder will recognize a capital gain or loss, which will be long-term capital gain if they meet that 1-year holding requirement. A corporate shareholder would be, again, subject to just the flat 21% rate on any gain it had. So what about redemptions? So redemptions are when a corporation basically buys back the stock from the stockholders. A redemption for cash or other property is taxed either as a dividend or a sale or exchange of stock. And a redemption is generally going to be taxed as a dividend unless one of the following exceptions applies. So the redemption is substantially disproportionate to the stockholder. And there are various tests you have to meet this disproportionate requirement. The stockholder owns less than 50% of the corporation's voting shares. The stockholder's ownership percentage of the corporation's voting shares is less than 80% of its ownership percentage of the voting shares before the redemption. And the stockholder's ownership percentage of the corporation's common stock is less than 80% of its ownership percentage of common stock before the redemption. That's very technical, but just generally substantially disproportionate is what I would remember. And the redemption completely terminates the stockholder's ownership in the corporation. If the redemption meets one of these exceptions, it is treated as a sale or exchange of stock, and the redeemed stockholder will recognize a capital gain or loss on the redemption. For the redeeming corporation, the redemption doesn't really have any tax impacts on the corporation. And then liquidations. And so we touched on liquidating distributions earlier. It's a taxable event. The corporation is going to recognize any inherent gain or loss on the distributed property. That's what we talked about. So inherent gain or loss would be, right, recall in that example where I contributed property worth $400,000, but a basis of $200,000 on formation. So the corporation took a $200,000 basis. So the inherent gain there is going to be that $200,000 that's sort of built in when they receive that property. So upon a distribution, or a liquidation of the corporation, right, that inherent gain would be recognized. And a stockholder is treated as if it had sold its shares in exchange for the liquidating distribution and recognized as a capital gain or loss. The stockholder will take a cost basis in any assets distributed in the liquidation. So as you can see, sort of the taxation of the corporation, a C corporation, is somewhat complex. The main thing that people are focused on is the double level, the 2 levels of taxation, which has sort of been minimized. This thing has been minimized given the flat 21% tax rate. The corporation, it doesn't provide you the same flexibility as a partnership. You can't have economic interests of the shareholders be vastly different. Than what they automatically are based on what's contributed. So if I contributed property worth $400,000 and my friend contributes cash with $400,000, typically we would each be 50-50 owners in a corporation. And so profits and losses would flow to us 50-50. In a partnership, of course, even though we're 50-50 owners, I could receive, if there were, if we met some very broad test, I could receive 70% of the profits, even though we're 50-50 owners. So there's some flexibility that a partnership provides, meaning an LLC, that a corporation does not provide. And so there's a lot to consider when deciding between a C corporation, an S corporation, and a partnership. We just hit a high level tax consequences of a C corporation here. Obviously, you want to engage your accountant when deciding what entity to form, and you want to make sure you're thinking through long term, what the long term goals are. We still are going to talk about the taxation of partnerships and multi-member LLCs, as well as S corporations. And actually, my colleague Spencer Newman, who's also an associate in the corporate and tax department here, is going to cover those issues for you next.
Thanks, Katie. Hey guys, my name is Spencer Newman. I'm also an associate here in the corporate group with Maynard Cooper, and I'm going to pick up and talk to you guys about taxation of partnerships and multi-member LLCs, and then we'll finish up with S corporation taxation and a little bit more general discussion of management and kind of operations of each one of these entities. So starting out with generally partnerships, I know Katie has gone through some details on taxation with C Corps. The partnership taxation it can really mean a true partnership, or it can be actually an LLC. So as Katie kind of discussed, there's the legal idea of whether it's a partnership or an entity, and then there's the taxation status. So on formation of a partnership, the partners can really contribute cash, property, or some combination of the two, however you prefer. However, if they're going to contribute property, of course, the parties will have to agree on the fair market value of that property. They can essentially have a tax-free contribution under the Internal Revenue Code. This cannot include services that are tax-free. So really, the property can include contractual rights. For example, that could be, a right to acquire property, but it cannot include actual services. And a transfer of an interest in a partnership to a person in exchange for services is generally a taxable event, unless that property is structured, properly as a profits interest. Although a contribution to partnership, it may be tax-free for U.S. federal income tax purposes. That contribution to the partnership may be subject to state and local tax laws, such as real estate transfer taxes. And for that reason, obviously, it's always best to consult tax counsel for the potential state and local tax consequences when you form a partnership. So the partner that contributes the property to the partnership upon the formation receives an initial basis, which we'll talk about more in a second. And you receive that basis in your partnership interest equal to the sum of the basis of the contributed property and the amount of the cash actually contributed. The partnership's tax basis and contributed property is the contributing partner's basis in the property at the time of contract. So there's also the idea of contribution of appreciated property. So this is an idea that there's property that has a fair market value that's different from the contributing partner's actual basis in the property at the time that property is contributed to the partnership. So when the partnership sells the property, the partnership has to allocate to the contributing partner any remaining gain or loss that existed on the date of contribution of the property. Obviously, because the property's fair market value exceeded or was less than the actual basis in that property. For depreciable property, the partnership has to allocate any depreciation deductions to the non-contributing partners so that they receive the deductions that they would have received if the basis of the property was equal to the fair market value. And getting into the idea of basis, a partner's initial basis in the partnership interest, like we just said, is going to be equal to the sum of that adjusted tax basis of the property and the amount of the cash contributed. The basis really determines essentially how much cash the partner can receive from the partnership tax-free and the determined amount of gain or loss on the sale of the interest or liquidation of the partnership when you reach that ultimate goal to sell the company. A partner includes its share of the partnership liabilities in the basis of its partnership interest. And this will result in an increase in the partner's share of a partnership's liabilities that will be treated as a contribution of money by the partner to the partnership. A decrease in a partner's share of the partnership liabilities will be treated as a distribution of money from the partnership to the party. And a partner's share of partnership liability always depends on whether the liability is recourse or non-recourse for partnership tax purposes. And of course, as you all know, your basis will change over time and fluctuate as your company grows and potentially shrinks. Profits and losses for partnership. Really, you're looking at a pass-through entity, which I know Katie already kind of discussed in detail the pass-through taxation concept with you guys, but we'll run through here is that, partnership is always going to be a pass-through entity for income tax purposes. And that means that it generally does not pay an entity level income tax. Instead, the partnership's profits and losses are allocated or passed through to the partners who include their respective share of those items on their income tax returns, whether or not it was actually distributed to the partners. And if a partner then owes federal income tax because of an allocation, then the partner must either come up with the cash or receive tax distributions from the partnership to pay the tax. And this is right back to the same thing that Katie discussed with respect to C Corps, is this phantom income issue. And the same idea applies here. So in a partnership, your operating agreement, if you're an LLC, or a partnership agreement can address this and include mandatory or permissive tax distributions. And often our clients just like to include a mandatory provision in there that says that, basically the members of the partners of the partnership will be required to distribute the applicable amount so that the partners aren't left with that phantom income and end up having to pay money that they didn't actually receive. So generally, with respect to distributions, there's generally no tax on the distributions of cash or other property from a partnership, unless the amount of money and the fair market value of the property distributed to the partner exceeds that partner's basis in the partnership interest. So all this, again, it really ties back to that initial basis calculation. So for an example, if one partner receives a cash distribution of $50,000 from a partnership, and the partner has a $60,000 basis in that partnership interest, this would not be taxable because the basis in the partnership interest exceeds the amount of cash distributed. However, the cash distribution reduces the partner's basis in its partnership interest to $10,000. That's $60,000 tax basis minus the $50,000 cash distribution. And also with respect to distributions, a partnership does not recognize gain or loss on a current distribution of money or other property to a partner. Now let's talk about the exciting stuff, and I guess maybe the long-term goal on the sale of a partnership. A partner generally recognizes capital gain or loss in an amount equal to the amount realized less the partner's basis in the partnership interest. So the gain is long-term capital gain if the partner has held the partnership interest for over 1 year. So with our clients, that tends to be the case. If you're selling your partnership, there's a good chance you've been in it for longer than a year, but maybe not. In this situation, though, a portion of the gain is ordinary income to the extent that the amount of money received by the partner is attributable to unrealized receivables, inventory items, or certain other specified items owned by the partnership. These are generally referred to as hot assets. A partner that is a C corporation, meaning that one of the partners in the partnership is a C corporation, is subject to the same 21% tax rate on both capital gains and ordinary income, whereas individuals are subject to tax on long-term capital gains at a maximum rate of 20%. So moving out of partnership tax, which again, this can kind of get confusing because partnership tax can apply to a true partnership or it can apply to an LLC. Now we're going to move on to S corporations, which are a little bit of a contrast to C corporations and to partnerships. As Katie mentioned earlier, when you form your initial entity, you can form a corporation or you can form an LLC or you can form a partnership. Just because you formed a corporation doesn't necessarily mean that it's a C Corp or an S Corp. When you form with the Alabama Secretary of State or whatever state you may choose, you simply have a corporation at that point. This S corporation tax status is a separate election that you would make after forming your legal entity in order to elect this tax status. So essentially, you have a United States C corporation, just like normal. You make your S election, and then you have an S corporation, pass-through entity. There's a few requirements, legal requirements to maintain S corp status. The most obvious being you can only have one class of stock. You cannot have more than 100 shareholders, and only U.S. individuals can be stockholders, with a few exceptions for certain trusts and things like that. It's also important if you want to form a C corp or an S corp, excuse me. You must make a timely S corp election on IRS Form 2553 that has to be filed with the IRS no more than 2 months and 15 days after the beginning of the tax year that the election is to take effect. So that's an important distinction. If you form a C Corp and you decide later that you want to achieve S Corp status, you can do that at that point. But it's important to kind of think these things through, and potentially, if you want to be an S Corp, just do it from the start, and you never have to worry about fixing it later. For formation of S Corps, the contribution of cash or property, again, on formation is generally tax-free, provided the following requirements are met. One, the cash or the other property has to be transferred solely in exchange for stock in the S Corp. So whatever you give to the S Corp, you're giving it in exchange for stock in that S Corp. The contributing parties are in control of the S Corp immediately after the contribution. And for this purpose, control really means ownership of at least 80% of the actual voting stock of the corporation, and at least 80% of all other stock of the corporation if there were, non-voting shares or something of that effect. As we've kind of hammered home, is that an S Corp generally is not subject to tax at the entity level, and the S Corp files informational returns reporting the income of the company and the loss and deduction that's allocated to its shareholders. S Corp shareholders report their allocable share of these items on their individual federal income tax returns, regardless of whether the earnings are actually distributed. And this circles back to the same phantom income issue, that these are reported by the shareholders individually, regardless of whether that earning is actually distributed to that shareholder. And S Corps don't really provide much flexibility for allocating profits and losses because it's so regulatory, and this is an IRS created tax election. So you don't have a lot of flexibility to do whatever you want here. And a distribution of cash to a stockholder is not going to be taxable to the extent of the stockholder's basis. But the excess is taxable to the stockholder as a capital gain. When we're talking about asset sales or stock sales of an S corporation, so say you grow your S corp, for a while, and you're ready to either sell the assets or sell the stock. Again, S corps are pass-through entities, so they're not usually subject to these entity-level taxes upon this sale. In an asset sale, if the S corporation sells an asset in a taxable transaction, then the resulting gain is allocated to the S Corp stockholders. Income, retains its character, either capital or ordinary income, depending on the type of asset that's being sold. In a stock transaction or a stock sale from an S Corp, the gain that's resulting from a disposition of an interest in S Corp stock is generally a capital gain for the selling shareholder. The taxable gain is equal to the difference between the proceeds that are received and that stockholder's basis in its shares. So as we get through with those kind of high level, but sometimes in-depth tax considerations, we have some non-tax considerations. So as a short recap, when you're considering which entity to form, as Katie brought up earlier, you can kind of choose your legal entity first, and then you can kind of consider what tax status you want to have. So all of these tax status, of course, should be consulted by your legal counsel and by an accountant. But some of the broader, operational issues can kind of be decided based on you and your business partners and how you guys particularly want to run your company. So let's break these down a little bit. In non-tax considerations, a C Corp really has no restriction on the type of owners. Any person or any entity essentially can own stock in a corporation, in a C corporation. In an S Corp, though, again, you are restricted because this is so regulatory. You can only have a maximum of 100 stockholders. So that's something to consider if you're creating an entity and you're going to operate a business that, your primary goal and, your expectation is that this is going to really take off and you're going to have tons and tons of investors, potentially over 100, then maybe an S Corp's not for you. And second, with certain limited exceptions, only U.S. individuals can be stockholders. There's certain trusts and some exempt organizations that are few and far between that could also be S Corp shareholders. So similarly, if you're starting your company and you know that you're going to be taking some investments very soon, and some of your interested investors or people that you hope to gain as investors are entities or institutional investors, and they're not individuals, well, then you're not going to be able to take that money from those people and maintain your S Corp status. So that's another thing to think about, is that we see clients pretty regularly, form an S-corp and they operate for a few years and they decide to take money, and they realize that they're a little bit limited in who they can take money from and still maintain their S-corp status. If they want to bring in a corporate or an institutional investor, it's going to blow their S-corp election. Third, an S-corp automatically converts to a C-corp if it does not meet these requirements. So say you did violate one of these requirements, basically you're just going to lose it. In the next year, you're going to lose that status and will no longer get the benefit of that taxation. So ownership requirements in general, in an LLC, which again, your LLC can be taxed as a partnership, or your LLC can be a disregarded entity if it's a single member, or your LLC can make an S election and be taxed as an S-corp. As far as the legal requirements for having an LLC, Alabama law requires that you just have one or more members. So it can be one person or one entity, or it can be multiple. And if you have two or more members in the LLC, it's going to be taxed as a partnership, whereas a single member LLC is really treated as a corporation of sole proprietorship. So, as we discussed earlier, it's a disregarded entity for tax purposes, but you still get your limited liability protection based on the fact that you have an entity in place. And LLCs have really no restriction on the type of owners. They can be individuals, they can be corporations, they can be other LLCs, they can be trusts, whatever you want. And then similarly, a limited partnership is two or more persons, and one of those persons must be the general partner and the other the limited partners. And there's really no restrictions on the types of owners in that scenario. Let's talk about the equity of a C Corp versus an S Corp. If you have a corporation that's taxed as a C Corp, there's two basic types of capital stock that you can have within that company: common stock and preferred stock. And you can create multiple classes, multiple series of stock that have different rights and preferences with respect to distributions, with respect to voting rights, and really some pretty deep flexibility there if you have a corporation that's taxed as a C Corp. If you have a corporation or an LLC that's taxed as an S Corp, again, you have these same three restrictions. You can really only have one type of capital stock, and that's common stock. So if you wanted to create, different layers and different economic rights for different investors in the future, that's going to be kind of restricted in an S Corp because you're pretty much limited to one type of capital stock. However, you can have different types of voting rights amongst that common stock, but you can't have significantly different economic rights amongst different series or different levels of stock in an S Corp. And there's also the concept that certain debt instruments, as well as certain types of options or stock options or warrants, can be treated as a second class of stock and blow an S election. So you have to be careful there. Generally, you want to keep it as simple as you can in an S Corp to avoid any kind of issues with that. LLC, generally, your rights with respect to the other owners or members, as they're called in the LLC, are really set out in the operating agreement. And Alabama law has really followed the Delaware code on this aspect and gives a lot of flexibility to the members with respect to their LLC and their governance. There's really significant flexibility with liquidation rights and distribution rights. You can't do whatever you want, but it's pretty close. An LLC will give you pretty much flexibility to agree amongst the other members, and whatever you guys agree to, as long as it's not illegal. In an LLC, you can just about get away with it. In a limited partnership, you have two classes of partners. Obviously, the general partner, who's responsible for the actual management of the partnership, and then the limited partner, which typically will be just a silent investor in the partnership. For a C corporation, or again, a corporation that is taxed as a C corporation, it's going to be governed by a typical board of directors that you're familiar with, like most companies, unless it's provided otherwise in the certificate of incorporation. The board of directors really call the shots, but they designate officers to manage the day-to-day operations of the company. So the officers will act at the direction or at the discretion of the board of directors. But certain, major decisions, which can be really laid out in your bylaws as well, will require additional approval by the stockholders. So if you're a stockholder in the corporation and the stockholders, have some limited say over the board of directors, and the board of directors have a lot of say over the officers. And S corporation operates the exact same way. Management of a limited liability company can, like we said, be very broad and very. There's a lot of discretion for how you want to do that. It's vested in the members, typically under Alabama law, unless it's otherwise provided in the LLC agreement. That means that if you just go file a certificate of formation and you start an LLC with your friend or with your business partner, it's going to be presumed that LLC is managed by those two members. The only way to change that is to provide in an agreement a written, or I guess technically you can have an oral operating agreement, but it's definitely not advised. Always better to have that operating agreement in writing. Until you have an operating agreement that provides for management of the company in some fashion other than the members, then that will be the status that you have. You'll be member managed. And typically we see a lot of our clients create management committees or board of managers. That's very common. And in that scenario, you can designate a board of managers or management committee that essentially acts like a board of directors. And it's a board of directors for an LLC. And those managers do not have to be members. They can really be whoever you want. They don't have to necessarily have any kind of connection or economic interest in the company, as long as they're willing to serve on the board of managers. And again, the operating agreement is going to govern whether member approval is required or whether just manager approval is required. And that's something that you can think about with your business partners as how much do you trust the board of managers versus how much control do you want to have as a true owner of the company? And do you want to be able to remove people from the board of managers, or do you want to pretty much set the board of managers and it be stuck indefinitely? Those are concepts to think about when you form an LLC. And at the initial formation, your board of managers just might be the initial members. But as a company grows and gets more and more members, you can add a member without adding that member to the board. So it's something to think about as far as your business strategy is who you want to be on the board of managers versus who's just a member of the company. In a limited partnership, the management is really vested in the general partner, but can be limited by the limited partnership agreement, of course. And major decisions, again, with a limited partnership, typically need to be approved by the limited partners, although they're basically silent investors. Give you a quick recap. I know there's a lot of tax considerations and legal considerations when you're forming an entity, but the simplified thing to remember is, under Alabama law, you can be a sole proprietor, which means you have really no limited liability protection. You're just, John Doe out there running his company from his house, which is typically not advised. You can create a limited liability company, you can create a corporation, or you can create a partnership. When you create a limited liability company, a corporation, or a partnership, you also have the ability to make an additional tax election on that entity. So you can have your LLC, your corporation, or your general partner, or your limited partnership taxed in a different way. And all these things are things to consider and things to run by your legal counsel or your accountant at the time that you form. And we're always happy to help you guys. And just give us a call or an email anytime you need us. And thanks for listening today.